So the title of this, and I was asked to give an overview of the changes in the U.S. legal landscape in 5 minutes, so I'm going to maybe skip a few things. Also want to thank a lot of people wearing ties here, so usually at a FinTech event we don't get that. The title of this was Reg A Plus and the Emergence of a New Product Universe, and that was Dara's title. And I thought about it, and I thought, geez, you know, that's kind of hyperbolic, and I don't know what to call this yet. But then the more I thought about it, the more I thought, yes, you know, this is actually a tremendous change. And in my career, which started in the late 90s, we've really seen a sea change in how investments are offered to the public in the U.S. And we're going to use a little bit of legal jargon, but it'll be over soon. So just hold on, and we'll take questions later. So many of you know the structure of U.S. securities laws. I think that's being cut off. There are various acts that have evolved over the years through Congress, and they create this patchwork of regulation. Sometimes you can do something on the Securities Act that's not permitted under the Investment Advisors Act. Sometimes you're free under the Investment Advisors Act, but the Investment Company Act comes into play. And so over time, through cases, through regulatory agency rulings, through Congress, we have this patchwork in place. But the primary ways of offering securities in the U.S. are through the U.S. Securities Act of 1933, which governs offerings, and then the Securities Exchange Act of 34, which governs regulation of public companies and broker-dealers. There's a general rule that no offering can be made unless it is either registered or exempt. So you can think of the world in two parts: registered offerings and exempt offerings. Stocks that you buy in the market every day, stocks that trade on the exchange, shares that have gone through IPOs, those are registered, filed with the SEC, full prospectus disclosure document, marketed out to the general public. That's one category. The vast majority of other securities are fund formations, are small private companies, startups, other types of hedge fund investments, private REITs, anything else you can think of where you're investing money into an enterprise that's not a listed company has to qualify somehow under the private placement rules. So April 5th, 2012, there we see the president with former Majority Leader Eric Cantor. He's no longer there. And we have Steve Case behind him, who is actually one of the big proponents of the Jobs Act. And then on the far right, looking down with the glasses on, is Congressman Patrick McHenry, who is really the key proponent in the U.S. House and continues to be to this day of the modern Financial Crowdfunding and Regulation A Improvements Acts. The Jobs Act was passed in 2012. The title was to increase American job creation and economic growth, improving access to the public capital markets for emerging growth companies. And it did more in one single bill than I had seen in 10 other acts of Congress relating to the securities laws. Certainly the most transformative law that was passed in my career. And really what it does is 3 or 4 main things, and I'll just touch on them briefly. IPOs, we now have confidential filings. We have reduced financial disclosure. We have Sarbanes-Oxley, where you don't have to report give the report of an auditor every year. A lot of that is gone into what we call Title I, the IPO on-ramp. Title II, private placement reforms. Private placements, remember the world before was public offerings and private placements. Now we have private placements that can be advertised. We have solicitation of private placements. It sounds oxymoronic, but it's actually interesting in that how you can do everything except go public and list on an exchange under the private placement rules now in a simple self-help process. Crowdfunding, a National Crowdfunding Act, you can raise up to $1 million. Title III is now called Regulation CF. It's been finalized. And Regulation A+, which we're going to talk about, which is Title IV, the ability to raise up to $50 million in an offering over a 12-month period. There's a method that is preempted, meaning you don't have to go through the state laws and ask for permission. And then there's the other side, Tier 2, which is not preempted. And we'll skip through some of these, but 3 primary uses of Reg A. There's a title at the top there that's been cut off. So what are the 3 primary uses of Reg A? The intended purpose of Reg A is to foster a capital formation, and the ability, the advantage of Reg A is that you're able to go out not only to accredited investors, which are people who have over $1 million of net worth, $200,000 of income, or $300,000 as a married couple. That's the definition of accredited investor. It may change, although given the results of last week, I don't think it will anytime soon. And I'm not saying that to be sarcastic, I just don't think it will. So the stated purpose of Reg A is to encourage capital formation, the perception that smaller people don't have access to early stage companies, that early stage companies don't have access to non-VC investors. This is an attempt to bridge that gap. You can now go through a Regulation A offering and you can raise money from non-accredited investors. Anybody who's over 18, who has a social security number for tax purposes, can invest in a Regulation A transaction. These transactions can be listed either on OTC or you can go out to the NASDAQ once you're out and qualified. Elio Motors is an example, car company in Phoenix. I think the first car comes out in 2018. Concept Car, they raised $17 or $18 million through a Reg A offering that is now listed on OTC. And the stock has actually outperformed the S&P 500 this year. The second way that we've seen Reg A make an impact is through equity REIT structures. So this Realty Mogul and Fundrise on the real estate side, they've created these entities where you can invest equity into a REIT. The REIT is managed by their advisor companies, and you invest in real estate transactions or loans that they pick. Now, if you're an accredited investor, you can go to Realty Mogul or Fundrise or Street Shares and invest in the loans directly. But if you're not an accredited investor, you still don't have to you take a back seat. You can invest in the REIT product done under Reg A, and that is a vehicle for everybody where they basically manage the investments into those products. And then the third thing that we've seen is this creation of, Dara gives me credit for inventing it, but I don't think I'm going to take that credit, but the recourse debt transaction, the ability to issue debt to the public, to turn the general public into your bank. You have a revolving line of credit from the crowd, and as long as you can issue securities to the crowd and they will buy them from you, then you have the ability to raise money, and the crowd is effectively your banker. It's what we call a bankless working capital line. It generates itself. You can have up to $50 million per year. It auto-renews as long as you continue to make your regular filings. And you don't have negative covenants. You don't have affirmative covenants. You don't have the expenses of going through a lending process, a committee process, paying their lawyers, paying your lawyers, et cetera. It's effectively just a bankless line, and you can flex the terms of the notes that you offer to the public to make them more or less marketable depending on what your response is from prospective investors. I think there will be some legislative reforms soon, both in marketplace lending and crowdfunding. McHenry is leading several bills in that regard, which we can get into later. And then also I think we're going to see payment-dependent notes, which are the Reg D notes that the accredited investors are investing in. I think those will be offered to the general public soon. So just to review, and we can make these available, the top there is different ways to invest without doing a public offering. And I've compared Reg CF, which is Title III, Reg A Plus, Tier 1 and Tier 2, and private placements Title 2. So the conclusion from this chart is that you have to really educate yourself on where you fit into the capital structure. You may be a company that has access to accredited investor money. I would probably recommend you go through the private placement process and do a solicited or unsolicited Tier 2 private placement. If you feel like you need more help from the general public, then you're probably a good Reg A candidate. If you are not really in either of those camps, but you're going to raise a small amount of money, then there's intrastate crowdfunding. There's raising capital under what we call Regulation CF, the new Title III, and you can go through that process. I think it's more expensive to do that, but you might be better off in the long term because you don't have long-term reporting requirements. And then we go through a little bit. So what about marketplace lenders and Reg A? So we're privileged enough to work with Street Shares on their Reg A offering. They were the first marketplace lender to register a bankless working capital line under Reg A. They offer notes to investors, both accredited and non-accredited investors. If you go to Mark's site, you can go through the process if you're accredited and invest in specific loans, or you can invest in notes issued by the company as a whole that are recourse to the company as a whole, and they're 3-year prepayable at any time. But in terms of time to market, it's interesting. When we filed this, it took a little bit of time for them to get up to speed on Reg A themselves at the SEC. We're seeing a much more streamlined response these days, where deals are getting out in 3 to 4 months, sometimes less than that if they're extremely cookie cutter. And I think that also remember ongoing filing requirements. You need to have an audit if you're going to do what we call Tier 2. The advantage of doing Tier 2, however, is that you don't have to go state by state and ask for permission, because remember, these are what we call non-preempted securities. A security that's not preempted means the federal securities laws have not trumped state law in this regard, and there is a complicated formula where the federal government has decided certain laws need to go through states and others don't, and the SEC split the baby on Reg A, and they said, Tier 1, go to every state that you want to qualify for, which is a longer process. Tier 2, you're exempt from that process. 2 states sued the SEC in an attempt to reverse that because they wanted to review on a state-by-state basis. The court threw the case out. So you can be preempted. You don't have to go through the states. You do need an audit, though, for those requirements. And then think about what your liquidity considerations are. Do you need a listed security? If you can really raise $50 million right at once, you may want to go for the registered offering and hit NASDAQ. If you're doing a Reg A plus deal and you're approaching the $50 million threshold, you need to watch and make sure that you have a registration statement that is going to take over, so that the day that you hit over $50 million, your investors' screens don't go gray and they call up and find out that, well, we're now a registered deal and we're no longer preempted in your state. So a lot of interesting stuff, a lot of complication, but really transformative in the way the securities laws have changed from a B world, registered or private placement, to one where there's private placements, advertised, non-advertised, accredited investor verification processes for the advertised, Reg A plus, the ability to go to non-accredited investors up to $50 million, don't have to go through the states anymore, and then the regulation crowdfunding, or Reg CF, which is now law as of last May, which allows investors to invest in deals up to $1 million in any 12-month period. And we'll take questions, or I'll see you guys at the cocktail hour.